Bloomberg Audio Studios. Podcasts, radio, news.
Joining us now, portfolio manager Nouriel Roubini of Atlas America Fund. It's been way too long, Nouriel. We got to get you in here more and more. You're traveling so much. We hardly see you. You've teamed up with Reza Bundy at Atlas America. Are you running money now? What are you learning running money at Atlas America?
We're not yet, actually. We're in quiet period. CCE is now approving our thing, so we'll be launching
in November.
So you're
in registration and
yeah, exactly.
And all that.
For now, I cannot speak about it.
This is going to be something to see Nouriel Roubini run money. In the world we're in, the great post-pandemic shock has been American exceptionalism, American prosperity. Are you willing to say this gift that we have is nothing but trillion-dollar deficits?
No, I wouldn't say it's only trillion-dollar deficits. I think that a whole bunch of things have happened. We had the Infrastructure Act, we had the IRA, we had the CHIPS Act, we had actually loose migration policies that led to an inflow of workers that increased the labor supply growth and reduced the inflation. So certainly the fiscal stimulus has helped at the margin, but I think also we consider this AI revolution a significant increase in capex by the private sector. Potential growth of the U.S., given technological innovation by the end of this decade, could be, in my view, higher than 3%. That's a revolution, right? China might be growing less than 3% by the end of this decade. U.S. might be growing faster than China. I know it's a bit of a bold prediction to make, but I think that in spite of the dysfunctionality of our political system, we're totally partisan and you name it, the private sector innovation is such in lots of the technologies and industry of the future. It's not just AI, it's robotic, automation, biomedical research, space exploration, new weapon system, ag tech, green tech, quantum computing. There is a flurry of new technology going to radically change the economy. And I think part of the strength of the economy that's been growing faster, the potential, in spite of the Fed for the last few years tightening, is there is a shift, is a regime shift.
Nouriel, you mentioned before we went on the air that you're going to be traveling pretty extensively over the coming weeks here. I suspect internationally they're going to be asking you about your thoughts on the U.S. election coming up. How would you frame a response to some of your international clients?
Well, I think that the major probable risk to the U.S. economy comes from the elections, and the economic policies of a new Trump administration will be very different than those of a Harris administration. If you take at face value what Trump says, he says, I'm going to impose tariffs on all imports in the U.S. of 10 to up to 20%, up to 60% on those from China. He wants to devalue the dollar because he thinks it's too strong and has led to deindustrialization. He wants a more dovish Fed, and he'll have a chance to change some of the leadership of the Fed. And the Center for Responsible Budget just the other day said that his fiscal policy will increase the deficits and the debt by $7.5 trillion over the next decade. That's well above what even Harris will have it, but it's unquote only 3.5. Right. And you will have a restriction to migrations, severe draconian restriction to migration. I don't know if it's going to deport millions of people, but even not letting them in implies a significant reduction in the labor supply. So all these things together, all these policies, trade, currency, migration, monetary, fiscal policy, in my view, imply higher inflation, lower economic growth, higher bond yields, and potential for a correction in equities.
You're not willing to give up on stagflation. A lot of people are saying maybe it's over.
I don't think it's over for the following reason. The three negative aggregate supply shocks of COVID, of course, have gone away. But as I pointed out, the economic policies of a Trump administration, in my view, are stagflationary, because whether it's immigration, whether it's the currency, whether it's trade, whether it's monetary and fiscal policy, they are increasing inflation and they would reduce economic growth. So that, call it stagflation light or stagflation, but they would be stagflationary. And as I pointed out in my mega threat book, there are other forces that are more medium term that are all stagflationary. Decoupling and protectionism, restriction to migration, aging of population, reshoring and friendshoring, geopolitical risk that lead to fragmentation, climate change, new pandemics, backlash against liberal democracy leading to fiscal policies that are pro-labor and union, increase wage growth, and potentially even de-dollarization, gradual, but they will increase essentially
Can you
import prices.
model, well, this is your
Yes.
wheelhouse. When you were with President Clinton, can you model a weak dollar?
Can I model it in which
Do you
sense?
predict a weak dollar?
It depends. If we have a very large fiscal deficits, and if we have very large current account deficit, these twin deficits are going to continue. In spite of the strengths of the private sector, I think at some point the bond market vigilante is going to wake up. And in the last few years, in spite of these twin deficits, the dollar was strengthening because we had tight monetary policy. And therefore, the capital account was essentially compensating for a very large current account deficit. But if that large current account deficit remains, at the same time, interest rate differential are implying that the capital inflow in the US are going to be less, let alone the fact that we are weaponizing the dollar and some country may be gradually de-dollarizing, that would imply over time a weaker dollar over time. I'm not talking about the crash of the US dollar, but it'll be the counter argument is that there is so much innovation in the US that the inflows of capital are not going to be into fixed income treasuries, but rather in equities. That has sustained, of course, the dollar for the last few years. If that continues, then that might be partially supportive of the dollar and lead it to less of a weakening.
Professor, most of us grew up with globalization as a theme, as something we learned and experienced. But that seems to have reversed itself a little bit over the last 4, 5, 6 years. A, do you agree with that? And B, will that continue?
Yes, I would say that both the trends of geopolitical fragmentation are leading to some degree of, call it either deglobalization or decoupling or de-risking or reshoring and friendshoring, or changing in the global supply chains from just in time to just in case, from China to China +1 or +2, from emphasizing in investment economic security rather than economic efficiency. So the question is not whether, the direction is one towards fragmentation is going to continue given geopolitics, given AI, given other pressures that are on labor income. The question is not whether, but only how much and how fast.
Nouriel Roubini with us here, folks. The Dow -92, the VIX 21.23. A little bit of weight to the tape this morning. Nouriel, with all that said, we're in a bull market. Tomorrow, JP Morgan earnings. For the last 10 years, annual return on JP Morgan's 12, 13, 14% per year. How do you explain the lift in asset valuations in America?
Well, I explain it by the fact that one, we achieved a soft landing, and we achieved it not because of what the Fed did, but because we got lucky. Those 3 negative aggregate supply shocks of COVID reversed themselves.
You think the Fed got lucky?
They got lucky because in any other situation, the Fed going from 0 in QE to 5.5 in QT would have led not only to lower inflation, but also to significantly lower growth and even a recession. Now, we had the lower inflation, but we did not have the recession. Why? My explanation is that 3 negative aggregate supply shocks of COVID, the impact of COVID on supply of goods and services and supply chains and labor went away. The impact of the shock of Russia, Ukraine on commodity prices went away, and China phased out the zero COVID policy. On top of those 3, we got other things that happened. One was immigration, 2.5 million people entering US for the last 4 years, documented or undocumented. That kept the lid on wage growth, increased growth. We had the AI revolution that also has led to significant increase in private capex. So all those factors explain why we said stronger growth and inflation went lower. Was not really the Fed. It was just we got lucky, and we got immigration, and we got the AI revolution.
Geopolitical risk, that's front and center for investors really over the last several years, probably more so than it has been in a while. Yet markets have seemed to churn higher. How do you factor, whether it's coming out of Ukraine or the Middle East, how do you factor that in?
Well, my explanation is that for the time being, markets have correctly estimated that all these conflicts are regional rather than global. After all, Russia and Ukraine is very ugly. It has damaged severely the Ukrainian economy, has caused some damage to Russia. It had initial impact on global commodity prices, but now more oil and natural gas from the Middle East, the US, has led to even the European being able to phase out the Russian oil. For now, the conflict between Israel and Hamas was on Gaza. There is a risk of regionalization. So far has not occurred. And the Cold War between US and China is a Cold War, but is probably not escalating at the speed it's going to become a hot war in the short run or having global consequences. So I think markets have correctly said these things are terrible for specific countries and regions, but they don't have a global impact. Of all of them, I would say the biggest risk today is that if Israel were to go and strike Iran, and there is a consensus within Israel, not just on the right, Netanyahu, but even people that are on the opposition, like Benny Gantz has said, we have to get rid of this regime in Iran. Then if Israel were to go to try to achieve regime change in Iran, you could have really a conflagration in the Gulf. You could have essentially the production and export of oil from the Gulf being blocked for several months. And you could have a shock like 1970 Yom Kippur or 1979 Islamic Iranian Revolution. I think that's the biggest risk. And by the way, if Trump gets elected, the chance is going to give a green light to Netanyahu to go and say, bomb the hell out of Iran, get rid of the regime, will be higher than under the Harris administration.
Where does Turkey fit into this? Your father moved rugs in Turkey years ago. Nouriel Roubini on the next Erdogan. What do you expect to see there?
Well, the economy is still quite fragile. The good news that he put in place as finance minister, Mehmet Şimşek, was actually very mainstream and orthodox.
Ex-Merrill Lynch,
yeah, it's very good, and therefore inflation is gradually falling, but still too high. But they're going at least in a direction that are less heterodox economic policy and gradually more orthodox one. So I would say that actually Turkey is a country that, based on overall fundamentals, strong manufacturing sector, innovation, good financial sector, could do well.
Okay, for Atlas America, we've heard this, Nouriel. Are you telling me, I got 30 seconds, are you telling me you're long Turkish lira? Is that going to be your first trade here?
No, I'm not long Turkish lira because the inflation rate is still too high, and the amount of monetary and fiscal and credit tightening is not yet sufficient. But I'm saying at least they're moving in the right direction compared to what was the situation before the last presidential election. So finally Erdogan has realized there was a risk of a currency and a financial crisis. He gave power to some orthodox central bankers and finance ministers, and therefore the economic policies are moving in the right direction.
Don't be a stranger. Nouriel Roubini, it's been way too long. Thank you so much. With Atlas America Fund, Roubini Macro Associates, and of course his affiliation with New York University.